You may have come across the terms insurance, reinsurance and retrocessional in market updates and roadshows. In simple terms, insurance is a contract whereby in exchange for the payment of a premium, an insurer promises to pay the insured a sum of money upon the happening of an uncertain event or a series of events. For example, a factory owner needs to purchase multiple strands of insurance including property, liability and business interruption. This is called direct cover, i.e. a client to the insurer. Insurers at Lloyd's and other large marketplaces who are providing insurance need to cover themselves. This is called reinsurance and is where insurers transfer portions of their risk to other parties, which will reduce the amount they would have to pay out themselves in the event of a large insurance claim. Most underwriters want to protect themselves either from a large catastrophe event or cumulative amounts from a series of events. The primary insurer is known as the ceding party and pays a portion of the premium collected to the reinsurer. The party that accepts the portion of the potential obligation in exchange for a share of the insurance premium is known as the reinsurer. There are two types of reinsurance: proportional, which is quota share, and non-proportional, which is excess of loss. Quota share reinsurance is where the risk, premium and losses are all split proportionally between the insurer and the reinsurer. For excess of loss reinsurance, the reinsured, i.e. the primary insurer, agrees to pay all the losses up to a pre-agreed amount which is called a deductible. The reinsurer will then pay the rest of the loss that exceeds this amount. The reinsured and the reinsurer do not share the risk, but they share the loss. In both cases, the loss can either be a single loss or a cumulative amount of losses, often called an aggregate. For example, if there is a loss to the factory owner of, say, £100,000, under a 75% quota share agreement, the insurer will pay £25,000 to the factory owner and the reinsurer will then pay the remaining £75,000. Under an excess of loss reinsurance policy with a deductible of, say, £40,000, the primary insurer will pay all £40,000 and the reinsurer will pay the remaining £60,000. When Lloyd's syndicates pass some of the risk on by purchasing reinsurance cover, this helps reduce their ECA, their economic capital assessment. There is a skill to syndicates purchasing reinsurance cover as the cost will reduce their gross premiums but will increase their overall protection. Some large composite syndicates, such as Hiscox 33 or Beazley 623, underwrite both insurance and reinsurance. Other syndicates underwrite purely reinsurance and some only pure insurance. Let's now take this a step further. Logically, the companies who are reinsuring the insurers may also want to cover themselves and transfer some risk. This is called retrocessional or retro insurance and is essentially reinsurance for reinsurers. If you wish to discuss this subject any further, please contact your private client director.